rhythm of the numbers ticking by. The stock market distills a basic economic principle, one that Azer had figured out how to exploit. The more risk you take with an investment, the greater the potential reward. If there's a chance that a single piece of news could send a stock plunging, investors expect greater possible profit for exposing themselves to those potential losses. A sure, predictable thing, like a municipal bond, meanwhile, typically returns very little. There's no reward without risk. It is one of the central tenets of investing. Azer, however, found an intriguing loophole in this mechanism, where the two elements had fallen out of sync. It involved stock options. The market for options at the time was far less crowded than regular stock trading, and in many ways more attractive. Options are contracts that allow a person to either buy or sell shares of stock at a fixed price before a specific date in the future. A put represents the right to sell shares of stock, which means that the owner of a put will benefit if the stock price drops, allowing him or her to sell the underlying shares at the agreed-upon higher price. Calls are the opposite, granting the holder the right to buy a particular stock at a specific price on or before the expiration date, so the owner of the call will benefit if the stock rises, as the option contract allows him or her to buy it for less than it would cost on the open market, yielding an instantaneous profit. Investors sometimes use options as a way to hedge a stock position they already have. At Gruntel, Azer had implemented a strategy called option arbitrage. There was a precise mathematical relationship dictating how the price of the option should change relative to the price of the underlying stock. Theoretically, in a perfect market, the price of a put option, the price of a call option, and the price at which the stock was trading would be in alignment. Because options were new and communication between markets was sometimes slow, this equation occasionally fell out of line, creating a mismatch between the different prices. By buying and selling the options on one exchange and the stock on another, for example, a clever trader could pocket the difference. In theory, the technique involved almost no risk. There was no borrowed money and relatively little capital required, and most positions were closed out by the end of the day, which meant that you didn't develop ulcers worrying about something that might send the market down overnight. The strategy would be rendered obsolete as technology improved. But in the early 1980s, it was like plucking fistfuls of cash off of vines, and the traders at Gruntel enjoyed bountiful harvests. All day long, Azer and his traders compared the prices of stocks to their valuations in the options market, rushing to make a trade whenever they detected an inconsistency. You could have IBM trading at $100 on the New York Stock Exchange floor, explained Helen Clark, who worked as Azer's clerk in the early 1980s. And the options that equal IBM at $100 trading at $99 in Chicago, so you'd run to Chicago and buy it and sell it at the NYSE. If done enough times, it added up. Without the benefit of computer spreadsheets, the traders had to keep track of everything in their heads. Azer set up a system that required minimal thinking. You didn't have to be good, he liked to say. You just had to follow the formulas. It was tedious. A trained monkey could do it. On Cohen's first day, he watched Azer work with a trading assistant, scouring the market for 25 cents or 50 cents they could make on their idiot-proof options schemes. During a lull in activity, he stared at the market screens. Then Cohen announced that he was looking at a stock, ABC. "I think it's going to open higher tomorrow," he said. Even brand new on the job, Cohen was confident in his abilities as a trader. Azer snickered. "All right," he said, curious to see whether the new kid with bushy brown hair and glasses had any clue what he was doing. "Go ahead, take a shot." Cohen made $4,000 that afternoon, and another $4,000 overnight. In 1978, this was a meaningful profit.